Have you ever experienced this? You buy a stock planning to make a quick profit and get out, but the price just keeps dropping. So, you end up convincing yourself, it's fine, this is a good company, I'll just hold it long-term as a value investment. Sound familiar? Turning a failed short-term trade into a forced long-term investment is the ultimate beginner trap. Why does this happen? Because people confuse two completely different financial games, trading and investing. Hi, welcome to ehamarkets Academy. Today, we're going to help beginners clear this up once and for all. What is the exact difference between investing and trading? Which one carries higher risk? And most importantly, which game should you be playing? Let's dive right in. Let's start with investing. To truly understand the difference, we have to look past the surface. The ultimate divide between investing and trading comes down to two completely different analytical frameworks: intrinsic value versus price action, and very different time frames. Let's look at the investor first. When investors invest, their core focus is the intrinsic value of an asset. Investors don't just stare at daily charts, they dive deep into the fundamentals. They read financial reports, especially the balance sheet, income statement, and cash flow statement, to evaluate a company's real operations, its financial health, and its ability to generate sustainable cash flows. Based on this, they build their valuation framework, asking themselves, is the current price undervalued relative to its intrinsic value? For true value investors, realizing real business growth takes time, which is why their holding period is often measured in years or even decades. When faced with short-term price drops, they don't panic sell. Instead, they strictly evaluate whether the drop has fundamentally shaken their original investment thesis. Trading, however, relies on a completely different logic. Traders are much more concerned with current price action and market sentiment. They usually don't take into account the company's long-term fundamentals. Instead, they focus heavily on changes in price, volume, and market structure. Their work focuses on the in-depth analysis of market data, prices, volume, fund flows, and more. Their methodology extends beyond technical analysis such as chart patterns, MACD, and moving averages, and may also incorporate quantitative models, statistical arbitrage, or event-driven logic. Common strategies include intraday trading and swing trading, capturing profits from price fluctuations across different timeframes. Therefore, a trader's time frame ranges from minutes and hours to a few days, a sharp contrast to the investor's time frame. In short, investors analyze fundamentals to capture long-term value. Traders analyze price action to capture short-term price movements. Now that we understand the frameworks, let's look at the reality of investing. Here pros, you won't get dragged around by short-term volatility, and you don't need to watch the market every day. But a 5% drop today is mostly just noise in a 10-year cycle, provided your investment logic hasn't changed. Long-term quality assets do have sustainable growth potential, though the journey is often volatile or stagnant for periods, rather than a smooth upward line. Because you aren't trading frequently, it's much easier on your emotions. Plus, in many countries, long-term investing offers tax advantages, like lower capital gains tax rates. The cons? First, capital lockup. Investing requires a long cycle, so it's only suitable for idle money, funds you absolutely will not need for the next 3 to 5 years. That's how you survive the volatility. Second, it's honestly not very exciting. Good investing is mostly about waiting. There's not a lot of action. Many people fail not because they don't understand it, but because it's too boring. It requires a discipline of active research, passive execution, to fight the urge to overtrade. It goes against human nature. As the saying goes, investing is a boring discipline. No wonder it is as exciting as the movies. The ultimate representative of this discipline is Warren Buffett. Starting in 2016, his company, Berkshire Hathaway, began building a position in Apple Incorporated, adding to it over the following years. The market saw massive volatility during this time, like the 2020 pandemic crash, but he didn't drastically alter his judgment based on short-term panic. Of course, this doesn't mean he never sells. He did trim and adjust his position later, but his core holdings remained intact. This patience, focusing on the nature of the business rather than the stock price, paid off massively. By 2024, the overall return on this investment reached nearly 800%. The logic is simple. When the underlying business hasn't fundamentally changed, short-term price action is just noise. Most of the time, the real skill is doing nothing. The hardest part of investing is enduring the boredom, surviving the volatility, and using time to let fundamentals play out. Now, let's shift our focus to trading. The pros. First, fast capital turnover. Profits and losses are realized much faster. If you do it right, you can see significant returns in days or even hours. That instant feedback is thrilling. Second, strategic flexibility. Traders can profit in both directions, going long in a bull market and short selling in a bear market. Third, high liquidity. Most trading strategies keep your capital flexible. You're not locked in for years. The cons? They are just as real. First, a much higher cognitive and energy load. Trading isn't just watching screens. It requires continuous decision-making, reviewing, and flawless execution. Decision fatigue is real. Second, leverage risk. Leverage magnifies profits, but it equally magnifies losses. Without strict risk control, you can lose money faster than you ever expected. Leverage doesn't just magnify your returns, it magnifies every human weakness you have. Finally, friction costs. Frequent trading means spreads, fees, and higher short-term taxes will constantly eat into your actual profits. Let's look at the classic case of legendary trader George Soros. In 1992, before Black Wednesday, his macro analysis concluded that the UK economy could not sustain the British pound's fixed range within the European exchange rate mechanism (ERM). There was a clear structural imbalance. Based on this, he built a massive short position. When the pound was forced out of the ERM and fell sharply on Black Wednesday, this trade brought him roughly $1 billion in profit. The core of this case wasn't just a lucky bet. It shows that when macro logic, market structure, and timing align, traders can concentrate their capital to magnify a short-term market inefficiency into a massive return. Let's put them side by side. Investing is more like a marathon. You spend time researching how a company makes money and its room for growth. Once the logic is solid, the most important thing is patience. Holding on through volatility and letting time unlock the value. Trading is more like an F1 race. It's a completely different game. It doesn't ask how far you can see. It asks how fast you react and how flawlessly you execute. The moment you enter a trade, you must know, if I'm wrong, where is my stop loss? What determines your survival isn't how many times you win, but whether you can keep your losses strictly within your rules. They are two completely different systems. Many people lose money not because they can't analyze, but because they mix the two up. They trade short-term without a stop-loss, and when they lose, they stubbornly hold on under the excuse of long-term investing. The real problem isn't whether you choose investing or trading. The real problem is you making decisions using a consistent, clear logic. If you lean towards the dynamic world of trading, if you want to use MACD, moving averages, and swing trading strategies on Forex, gold, or indices, you need a platform built for speed and professional analysis. That's where ehamarkets comes in. ehamarkets provides advanced charting tools and ultra-low spreads, allowing you to execute two-way trading seamlessly. Terrified of the high risks of trading we just discussed? Don't worry. On ehamarkets, you can open a free demo account loaded with virtual funds. You can practice your technical analysis, stop-loss management, and short selling in live markets without risking a single cent of real money. If you found this video helpful, hit the like button, subscribe, and tell me in the comments, you more of a Buffett or a Soros. See you in the next video.